Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can follow me on Twitter at @ExporterTax. On this week's episode of Cross-Border Tax Talks, I'm excited to have Aaron Junge back on the podcast. Aaron is a newly admitted international tax partner based in PwC's Washington National Tax Services practice. Prior to joining PwC, Aaron served as Tax Counsel for the Committee on Ways and Means of the United States House of Representatives during the run-up and passing of the Tax Cuts and Jobs Act, otherwise known here as U.S. tax reform. Aaron, congratulations on your admission to the partnership, and welcome back to the podcast.
Thanks, Doug. Really appreciate that. Glad to be back.
So, Aaron, before we dive into the new dividend received deduction regulations, I was hoping that you could share a little bit about your experience on the Hill. Specifically, you were an advisor before you joined the government and after. Can you reflect on how that experience impacted your work helping draft legislation and your general views on deep technical experts like yourself going between the private and public sector?
Yeah, sure, Doug. Great question. And first and foremost, I have to say that I really enjoyed and appreciated my experience on the Hill. Really a great opportunity to do something of civil service, and also just fabulous people to be working with, really smart people there, both the members and the staffs. And so great experience. You mentioned, the experience of professionals like myself working in private practice before and after working at the government. And I found that very valuable for me to be able to do my job at the government when I was, serving, the members and effectively the U.S. People as my client, members being my client, and when I came back to private practice, when I was there, I frequently drew upon my prior private practice experience. We'd be going to drafting and thinking about, here's the concepts that the members want to enact, and how do we distill them into legislative language? And as we work through that legislative language, I'd look at it and say, well, gosh, in practice, we saw language like this in the past, and there was always, questions about it. It was ambiguous. Is it disjunctive or conjunctive? Or, does it create an adverse inference in other parts of the code? This term, what does it mean? It's not clear. And, being able to bring that perspective to drafting, I thought was very valuable, because what we could do was use that to improve the language of the code to make it clear what Congress was trying to do. Or in some cases, it made us think about, well, it wasn't clear what we were trying to do. Let's think about it a little deeper, because we know the big picture policy goal, but there's levels deeper than that. The other thing that I thought was really useful about that experience when I was there was I could bring some practical experience or perspective as to what the impact of these provisions could be, of the impact of these changes, and of different proposals, right? We weren't just starting with the Tax Cuts and Jobs Act and just moving it through, right? We were starting with a variety of different proposals, and part of my job was to advise the members, hey, this is what this proposal would do. This is the impact of this proposal, so that the members can make a decision about what made the most sense in light of their constituents' interests and the people that they represent. And that practical experience, I think, by and large, comes from taxpayers, from stakeholders coming in and talking to the government and sharing their perspective on proposed legislation. And so I continue to encourage everyone do that. Exercise your First Amendment right to petition the government, go in and talk to your representative and explain to them what you think of the bills that have been passed and the bills that are under consideration, because otherwise folks at the government really don't know. You're taking your best shot based on what you think makes sense. And when someone comes in with private practice experience, I can share that and provide some perspective. But all that goes into a mixing bowl with all the perspectives shared by stakeholders, and we get better legislative product and better policies at the end of the day when we can take all that into account. So I found that very valuable, having that experience. And since coming out of the government, I have found the government experience to be extraordinarily helpful here, extraordinarily helpful in private practice as well. Certainly it's gave me a head start on knowing everything that was in Tax Cuts and Jobs Act, because I watched it write it, so I know the provisions in there. But more than that, it gives me a perspective on how legislation comes together, and gives me a perspective on why things are drafted the way they are in the statute, why things appear in legislative history the way they do, and why things are just left omitted sometimes. And I think that's helpful for interpreting the Tax Cuts and Jobs Act. But I think it's helpful for interpreting any part of the Internal Revenue Code, or frankly any law for that matter. Because it's, before going to the government, I always kind of viewed the process as a black box and didn't really understand why we ended up with some of the things we did. Right? You hyper focus on some of the language in the code, and you ask yourself, like, who came up with this language? Why would they write it that way? I can't say the answer is always satisfying, but what I can say is I have a better appreciation of why the language is that way now. And I think that's helpful for clients just trying to figure out, how they comply with the code. And so I found that very valuable coming out of the government as well.
Well, that's some really great reflection, Aaron. Thank you. And I think it's really important, part of our process, to have really deep technical experts that have practical experiences to be able to draft, whether it's legislation or the same with Treasury regulation. So I really think that's an important part of the process, and I think it's a great experience for both practitioners and governmental officials to have those people to be able to reflect upon. So thanks for that perspective. So let's move on to the topic at hand here, which is the dividend received deduction regulations that we got on August 21st, 2020. We received final as well as more proposed regulations. But before we unravel the new regulations, can you remind our audience what 245 Cap A is? And it really was is a fundamental change to our system of international taxation, the move to what we've debated on here, our so-called territorial system. And can you just talk a little bit about the general architecture of our new system and how 245 Cap A plays a role in it?
Sure. Yeah. So, it's worth taking a half step back in history and think about where we were before the 2017 bill. So, leading up to that, almost every industrialized country in the world had adopted some form of territorial or participation exemption system, whereby domestic earnings were subject to domestic tax rules, but foreign earnings weren't subject to domestic tax rules. They were subject to whatever foreign tax rules applied. And when those earnings came back to the ultimate parent jurisdiction, they weren't subject to a second level of domestic tax. They were exempted, based on being earnings based in a different territory. That stood in contrast to the U.S. system, which had this kind of worldwide taxation with deferral. Right, the idea was the U.S. generally didn't tax foreign earnings when they were earned, but taxed them when they were repatriated back to the U.S. And it created this significant incentive for U.S. companies to retain their foreign earnings offshore, to reinvest them in foreign operations instead of bringing them back to the U.S. for investment in U.S. operations or distribution to shareholders to be reinvested in other investments. And there was broad agreement that system of deferral didn't make any sense from a policy perspective, or wasn't the best way of doing things. That the way the rest of the world had gone with territorial or participation exemption systems was the better path. And that was agreement. That was kind of bipartisan agreement. You'd find folks across the political spectrum thinking that. And so the mainstay of any U.S. international tax reform leading up to 2017 was a participation exemption, was a dividends received deduction that exempted dividend income from foreign subsidiaries from being subject to U.S. tax, right? To ensure that those earnings were subject to foreign tax to the extent the foreign laws applied, but when they came back to the U.S., a second level of U.S. tax didn't apply. And so that was a mainstay of the U.S. international tax reforms in 2017 as well. And so the first section you see in the international subtitle of the bill is establishing the participation exemption system. It's enacting Section 245 Cap A, which provides, as you said, a dividends received deduction, right? A deduction for dividends received from foreign subsidiaries. So if you meet a series of requirements, you get this deduction exempting that dividend income from U.S. tax. and ensuring we have a territorial system consistent with the rest of the world.
So I will remind our listeners that we also obviously have the GILTI regime, right? The global intangible low taxed income. So that obviously applies in conjunction with 245 Cap A and our DRD system. So there is this big bucket of tax that is now, that is generally earned in the CFCs that is subject to current U.S. taxation to the extent it's profitable and there's a return beyond QBI. We've spent a lot of time talking about that on the cross-border tax talks, but it's really the other pot of earnings, if you will, that's not a technical term, of those earnings that haven't yet been subject to U.S. tax. When taxpayers want to bring those earnings back, unlike the old system, it can now be tax-free under our 245 Cap A regime, assuming you qualify for that. So we've received some regulations specifically really focused on extraordinary dispositions and extraordinary reductions. And I want to talk about what those are and what the final regs as well as the proposed regs did. But the regulations still don't cover a number of kind of just, I think, what I would view as some general operating provisions of 245 Cap A. Can you frame a little bit what's covered, what's not covered? I think we're hopefully waiting still on some more guidance, but give a little framework on what have we seen and what's still yet to be seen from a regulatory perspective.
Yeah, so the regulations that we've received under 245A really come into two buckets. So the DRD that I mentioned, it has a number of limitations on it, and one of those limitations is that hybrid dividends, so dividends that are treated as dividends from a U.S. perspective, but that are treated as deductible amounts from a foreign perspective, so maybe they're treated as like deductible interest expense from a foreign perspective, those don't qualify for the DRD, and they don't qualify because they don't meet the standard I described earlier, right? They're not subject to foreign tax law because they're not treated as distributions of earnings in the first place, right? They're deductible amounts, they reduce the foreign tax imposed on those earnings. They haven't been subject to foreign tax. If they haven't been subject to foreign tax, then arguably they should be subject to U.S. tax, and they get subject to U.S. tax by denial of the DRD. We've received, proposed, final, and new proposed regulations related to hybrid dividends, and that limitation on the 245A DRD. And then we've also received, temporary proposed, final, and new proposed regulations limiting the DRD in certain cases, namely with respect to extraordinary dispositions and extraordinary reductions, which we're going to talk about in a little bit here. What we haven't received, but it's definitely out there, and there's been some reference made by Treasury and IRS officials as well as in the preambles, is the kind of mechanical rules around the DRD. So, the DRD only applies to distributions of certain earnings by certain corporations to certain shareholders, meeting certain ownership requirements, certain holding period requirements. And a lot of those rules are pretty straightforward in the statute. It's pretty clear whether or not you own 10%. It's pretty clear whether or not you have foreign source or U.S. source earnings. It's pretty clear whether you meet the 1-year holding period requirement and so forth. But there can definitely be cases where it's not so clear. Things like where there's an nimble dividend, things like where there's kind of strange aspects of the foreign source portion ratio, circumstances where it's a foreign sub receiving the dividend as opposed to a U.S. shareholder and so forth. And those mechanical rules, the kind of nuts and bolts of 245A that I think about, we haven't received regulations in that respect yet. And I have no doubt we will. I suspect that's what 245A-1 through -4 are, but we haven't seen those yet. The piece here that we're going to talk about, and you'll probably want to set it up a little bit more, Doug, but just to say it at the outset, because you mentioned the GILTI rules, and I think those are important. The rules that we're going to talk about today have to do with Treasury's concern about certain earnings that, in Treasury's view, should have been subject to either, the U.S. GILTI rules or the transition from the old deferral system to the new territorial system, what we call the Section 965 toll charge, but weren't. And, one thing I'll note on that, and then we can talk about it more if you want, or we can move on to other parts of these regs, but one thing I will note is, the reforms that came in 2017 to the U.S. international tax system, as I said, they start with that 245A DRD, right? They start with the move to a territorial system, and then they layer onto that, additional anti-base erosion provisions, and the kind of one front and center is the U.S. GILTI regime, right? This idea that certain, deemed intangible and potentially low tax income is subject to immediate U.S. taxation to ensure that U.S. taxpayers aren't eroding the U.S. tax base by shifting excess amounts of income to foreign subsidiaries. That is, I don't view that as the building block of the U.S. new international tax system. I view it as kind of the next block up, right? It's the base erosion system layered on top of the territorial system we moved to. I think that's important when we're thinking about the framework here, because you mentioned, Doug, that we've got this other pot of earnings that are subject to the DRD when repatriated, and I might view it just a little bit differently, that all earnings are potentially eligible for the DRD when distributed, but some of the income earned by CFCs is going to be subject to an anti-base erosion provision, subject to immediate U.S. tax, and thus it'll never get to the DRD phase because it's already been included in the U.S. tax base through an anti-base erosion provision.
I think that characterization is fair, and it might be a glasses half full or glasses half empty type of analysis. But we might have to agree to disagree on that one. But your point is well taken. So I think that's a perfect transition, Aaron, to the extraordinary disposition rules. You had mentioned the desire that Congress had, understandably, to tax historic earnings under our 965 toll charge. So all of those earnings that had been deferred from U.S. tax, and then the desire on a go-forward basis to be subject to the GILTI regime and the territorial regime, or in reverse order if you so choose. But because of taxpayers that had fiscal year ends different than as opposed to a calendar year end, there was, I think, what was referred to as donut hole, right? This time between when the new law applied and when the old law applied, that created some concern for Treasury as they were thinking about what earnings should be subject to or should qualify for this new dividends received deduction. Can you unpack what an extraordinary disposition is?
Yeah, sure. So, like you said, the transition from the old system to the new system generally happened at the end of 2017, right? And part of the transition was the Section 965 toll charge. It said, hey, all of your earnings earned before 2018, if they haven't been subject to U.S. tax already, they're going to be subject to U.S. tax, one-time, reduced rate, and we'll let you pay the tax in installments. But what we're going to do is we're going to flush out all the pre-2018 earnings and say all those are covered by toll charge. And the new system applies on a go-forward basis to post-2017 earnings, right? And so the way the statute did that is it had a specific measurement date. It said check your earnings as of 12/31/17, and that's where you're going to cut it off. And there is a second measurement date for planning purposes, but to address potential planning concerns. But the general rule was cut it off on 12/31/17. That's when the old system ends. The new system, as we've talked about, includes both the DRD as well as the anti-base erosion provisions, including GILTI. And GILTI was made effective for the first taxable year beginning after 2017, which for calendar year taxpayers, that's January 1st, 2018, right? That's when your first taxable year begins. But as you mentioned, for fiscal year taxpayers, that's not going to be January 1st, 2018, right? If you've got a March 31 fiscal year end, you've got an April 1st fiscal year beginning, which means GILTI kicks in on April 1st, 2018. And that period between December 31st, 2017, when toll charges captured everything, and April 1st, 2018, when GILTI starts to apply, that little period is what you're referring to as the donut hole. That's the part of time where earnings that are earned during that period are eligible for the DRD when they're repatriated back to the U.S., so they're not going to be subject to U.S. tax upon repatriation, but they don't have to run the gauntlet of the new U.S. anti-base erosion rule. They don't have to run the gauntlet of the U.S. GILTI rule. And that's the period where Treasury became very concerned that what taxpayers may do is engage in transactions between related parties during that period to recognize significant amounts of gain that they don't pay U.S. tax on under the GILTI rules, under the toll charge rules, or upon repatriation because of the DRD. And that gain, recognizing gain in that transaction provides some future U.S. tax benefit, right? Either in the form of stepped up basis and assets that they can depreciate or amortize to reduce future GILTI inclusions, or reduce future U.S. taxable income if those assets come back to the U.S., or other transactions that provide a future tax benefit with respect to that gain that's not actually subject to U.S. tax. And so what the extraordinary disposition rules do is they go after those transactions. They say, okay, if you had a disposition of property between related parties that's outside the ordinary course of business during that donut hole period, so during that period between toll charge applying and GILTI becoming effective, then those earnings are going to create what's called an extraordinary disposition account, and they are going to potentially be ineligible for the DRD in part when they're repatriated back to the U.S. And those are the rules that we saw in the temp regs that were released last summer, and those are the same rules that we see in the final regs that we got just a little under a month ago.
Let's go through some of the specifics and changes, Aaron, that we've seen in the final regs briefly. There's a number of exceptions and specific rules that are unpacked, but I thought maybe we'd start with if IP is sold to a third party within a year, because it would not be unusual for a client a taxpayer to put together, a group of assets for disposition, for example. And I think there's some example and some questions that the taxpayers had raised about that type of provision. So can you tell us a little bit about that changes, and then any other relevant changes that we should highlight as part of the final regulations related to extraordinary dispositions?
Yeah, sure. So the first one that you mentioned there about IP relates to what is an extraordinary disposition, right? And again, I described it as kind of one of these related party sales within that gap period that's outside the ordinary course of business. And that last piece is important, right? So if you just have like ordinary course inventory sales between affiliates, no problem, right? Treasury's not going to be concerned about those. Sure, those earnings aren't subject to toll charge, weren't subject to GILTI, but also, I mean, it doesn't suggest you were doing any tax motivated planning. It's just in the ordinary course of business. The temporary regs have a provision that says dispositions of IP between related parties are per se outside the ordinary course of business. In other words, we're going to treat every sale of IP as an extraordinary transaction and potentially an extraordinary disposition, even if it's the kind of thing you were doing in the ordinary course of business. The final regs pare back from that a little bit. And they say, well, look, some IP, not all IP, but some IP we think, actually can be, we Treasury think can be sold in ordinary course transactions, even between related parties. And so we're going to allow you to treat some of those transactions as ordinary course, but only if you can show that there was a reasonable expectation that the IP was going to be resold to a third party within 1 year. So think, maybe you've got some like software related IP that, you're packaging up, like you said, in anticipation of selling it to a third party. You package it up by doing a related party sale, and then within a year you make that sale to a third party. That transaction could be within the ordinary course of business, and as a result, that transaction may not be an extraordinary disposition, and it may not invoke these rules. One thing I'll note about that is these rules only apply to transactions that happen during that donut period. That donut period can't go past November 30th, 2018. And if you were going to resell it within 1 year, that means you would have resold it by November 30th, 2019. So nobody's planning into this exception, right? Either your facts lined up with it or they didn't, but there's nothing you can do to like plan into it that I'm aware of. Maybe you are, Doug. I think it kind of is what it is. I think there's still work to figure out whether you meet the requirements of it, and I think it'd be helpful for folks. But it's kind of a what's done is done aspect of these rules. Another change in these rules that I think is helpful, won't affect every taxpayer, but I think it's helpful, is mitigating the circumstances where these rules produce double taxation. So again, what these rules do is say, hey, certain earnings haven't been subject to U.S. tax yet, but we think they should have been. So we're going to deny basically half the DRD is how the rules work. We're going to deny half the DRD when those earnings are repatriated back to the U.S. What these rules say is, well, look, if the earnings were already repatriated in a taxable transaction, so they were repatriated through an investment in U.S. property that resulted in a taxable 956 inclusion, or they were repatriated in a dividend that didn't qualify for the DRD because of a failed holding period. These regs say, okay, in those cases, you can go ahead and reduce your extraordinary disposition account by the amount of the taxable inclusion there, because you've already picked up those amount of earnings, and if we cause you to have a second taxable dividend, we'd basically be double taxing it, and that's not the purpose of these rules. So I think that's a useful aspect of these. Beyond that, the regulations are generally in the same framework as where the temp regs were last summer, there are some helpful clarifications. One of them is in the deal context. The regs helpfully address what happens with a 338G election, right? Typically, a 338G election is going to clear out all your attributes, and that makes a lot of sense here as well. And so the regs address those, and I think that's going to be important for what's a pretty common transaction for acquisitive companies that are making those elections. And then also these regs address when there's multiple U.S. corporations within a multinational group, whether it's foreign parented or U.S. parented. These regs are going to treat those related U.S. corporations as a single corporation for the purposes of these rules. And that can be important because you may have a CFC that's jointly owned by multiple shareholders, including multiple U.S. shareholders. And you might have been wondering under the temp regs, okay, well, if distribution goes up to one, but that one didn't have the extraordinary disposition account because it was issued stock later in time, what happens with these rules? And so by treating them all as one corporation, it becomes clear that a distribution up to either of one is going to likely trigger these rules and result in a taxable amount under the ED construct.
Well, thank you, Aaron. That's a great summary of what I view as really some of the important provisions. And I actually absolutely agree on the dispositions of IP. That's water under the bridge at this point. But I know that there were a number of taxpayers that had fit into that fact pattern that think that clarification was helpful, given the retroactive nature of the transaction. So let's move to the extraordinary reductions account. And this is something near and dear to my heart. I wrote an article, as you well know, about 951 A2B about 15 years ago. And what I came to learn after these extraordinary reduction rules came out, that I think I might have actually been the only person, or we were the only people that had actually written and thought a lot about how changes in U.S. shareholders and inclusions of subpart F income interact, some of the complexities that are associated with that, and frankly, some of the gaps that may exist in those rules. And those became even more highlighted, I guess, or really came into attention for the international tax community after GILTI. Can you, and this is a challenge, Aaron, can you briefly explain what an extraordinary reduction account is? And then we can talk briefly about the regulatory changes.
Sure, Doug. So an extraordinary reduction concern arises whenever there's a change in whenever there's an ownership change with respect to U.S. shareholders, and as a result of that ownership change, less subpart F, or there's a smaller subpart F or GILTI inclusion than there would have been otherwise. And so 951A2B is probably the best example, the one you raised, where if there's a change in U.S. shareholders and the seller, right, the transferor received the dividend before the change in ownership, that dividend is going to reduce how much subpart F or GILTI inclusion the acquirer has. And, that rule kind of made sense back in 1962. Basically, what it was saying is, hey, if the seller picked up a dividend, then the buyer doesn't need to pick up, a subpart F inclusion with respect to the same earnings, because the earnings were already picked up by the seller. The kind of strange results post TCJA or post U.S. tax reform is that the subpart F rules mitigate double taxation through a foreign tax credit, whereas for dividends you mitigate double taxation through this DRD, through this participation exemption. And so if you treat a dividend the same as subpart F, if you treat the picking up the earnings to a dividend the same as picking up the earnings to a subpart F inclusion, before reform that made sense because it was a foreign tax credit mitigating double taxation either way. Post reform, though, you're allowing taxpayers to get a different result, right? You're allowing them to take the DRD with respect to those earnings when normally they wouldn't get the DRD. What they would get was a foreign tax credit, which may not cover all the U.S. tax. And so what these rules are saying is, hey, if you have one of those ownership changes and you have a dividend during the year that reduces how much subpart F or GILTI inclusion the acquirer has, then we're going to deny the DRD available on that dividend, unless an election is made to ensure that the transferor picks up that subpart F or GILTI inclusion to make sure that the right amount of U.S. tax is getting paid on those earnings.
Aaron, what do these final regulations now tell us about extraordinary reductions and that election that is needed that are really different than the temp and proposed regs?
Yeah, so the final regulations are almost entirely the same as the temporary regulations. The important change to me relates to the election you described, right? That election is to close the year end of the CFC that was making the distribution, right? And by closing the year end, what you do is you ensure that the transferor picks up the subpart F or GILTI conclusion with respect to the earnings of that CFC. And as a result, you don't have to worry about the buyer only picking up a portion of it, as reduced by the dividend, because the buyer is just going to pick up the rest of the year. The first part of the year, the pre-ownership change part of the year, could get picked up by the seller. In the temp regs, there's a consistency requirement that says, hey, look, if you have a transaction in which one ownership change affects the ownership of multiple CFCs, or if you have a transaction where there's multiple ownership changes with respect to the same CFC, then if you want to make the year-end election, you have to make it with respect to all the CFCs affected by that one ownership change, that one extraordinary reduction, or you have to make it with respect to all those owner changes or extraordinary reductions with respect to that one CFC, right? So it's kind of a consistency requirement for all the transactions or all the CFCs. What the final regs do is say, hey, actually, if that consistency requirement still applies, but it only applies with respect to extraordinary reductions for which there is an ER amount. In other words, it only applies for transactions that would actually invoke these rules and cause a denial of a DRD. If you have a bunch of other transactions that happen as part of the same plan, or if you have a bunch of other entities that are subject to these that experience an ownership change, but with respect to which there wasn't any application of these rules, you don't have to close their year ends as well. And that could be really helpful for taxpayers that are engaging in complex transactions. They might have an ownership change of one CFC with 50 CFCs underneath, and they may only have these rules applying with respect to the top tier CFC. But on the temp regs, we would be concerned that year-end election, if made, had to be made before all 50 of those CFCs. So you're filing 50 extra 5471s and going through that. These rules make clear that, look, if the rules are only going to apply to one of them, if you're only going to have an ER amount with respect to one of those CFCs, then you only need to close that year-end. And the rest of them, you just kind of go on business as usual.
Yeah, I think that's certainly a helpful clarification, particularly given the complex nature of the structures that many U.S. MNCs are dealing with. We only have a few minutes left here, but I did want to briefly touch on the proposed regulations, and all of these are just really complicated topics. But the proposed regulations provided for coordination of the extraordinary disposition rules from the final regulations. And then there are also disqualified basis rules under the 2019 final GILTI regulations. Those disqualified basis rules generally apply to assets, and I think most commonly IP, that had been stepped up under one of these so-called donut hole transactions that you described through an extraordinary disposition. Can you just briefly, why has this been such an important issue? Really, it's the potential for double taxation. And then can you give us a quick synopsis of how Treasury, because there was a lot of comments on this, about how Treasury has decided to deal with this potential for double taxation?
Sure. So the issue we're thinking about here, so as you described, Doug, right, these disqualified basis rules were enacted as part of the GILTI provisions, and they apply to the buyer side of an extraordinary disposition, right? So again, think about the extraordinary disposition happening during the donut period. The seller's picking up a bunch of gain that generates earnings that aren't subject to immediate U.S. tax, and that potentially would be eligible for a DRD when repatriated, but for the ED rules. On the buyer side, the buyer's getting stepped up basis in the assets, which the buyer could depreciate or amortize and use to reduce future tested income for GILTI purposes, or other or future subpart F income, or future U.S. taxable income if it's on the U.S. return. What the disqualified basis rule said was, hey, look, if it's a CFC that was the buyer, that basis, as it's recovered as amortization or depreciation deductions or as a loss, we're going to allocate that to residual income. So we're not going to allocate it to reduce subpart F income. We're not going to allocate it to reduce tested income and ultimately a GILTI inclusion. Instead, we'll just allocate it to a residual income category that has no U.S. tax benefit. And the concern folks had was, well, look, we understand that the disqualified basis rules are addressing Treasury's concerns with these transactions on the buyer side. We understand that the extraordinary disposition rules are addressing Treasury's concerns with these transactions on the seller side, but you shouldn't apply both, because if you tax me on the gain on the seller side through a denied DRD, and then you deny the benefit on the buyer side through loss amortization deductions, then I've basically been hit twice, right? Either I should pay the tax on the gain through a denied DRD, but then get the benefit of the amortization deductions, or I should lose the benefit of the amortization deductions on the buyer side, but then I shouldn't be paying any tax on the dividend or the gain on the seller side. And so what the proposed regs do is address that concern, right? Treasury and IRS said, yeah, you know what, we agree, you should only get hit once on this stuff. And so we're going to coordinate the disqualified basis and extraordinary disposition rules. And there's a few different ways they could have done it, right? They could have said, hey, if you have disqualified basis, you don't have an extraordinary disposition account. They could have said, if you have an extraordinary disposition account, you don't have disqualified basis. Instead, what they've done is they've said, look, we're going to make you set up the ED account. We're going to make you set up the disqualified basis. And then as you have taxable dividends coming out of the ED account, go ahead and reduce your disqualified basis. And as you suffer U.S. tax detriment from the disqualified basis, go ahead and reduce your ED account. So you're only going to get hit once, but it's going to be on whichever one happens first, right? You won't have an ED account with no disqualified basis where you can just defer the detriment of the ED account indefinitely. You're not going to have disqualified basis with no ED account where the disqualified basis may not actually create a U.S. tax detriment. You're going to have both. But as you suffer a U.S. tax detriment from one or the other, you'll reduce the other one. So the proposed regulations have a series of rules that reduce extraordinary disposition accounts to the extent you've suffered a U.S. tax detriment under the disqualified basis rules, and reduce your disqualified basis to the extent you have suffered a U.S. tax detriment under the extraordinary disposition rules. And basically what they say is, hey, that ED account you have, go ahead and reduce that as you recover the disqualified basis, but only to the extent that disqualified basis actually creates a U.S. tax detriment through reduced, increasing the subpart F inclusion or GILTI inclusion that you otherwise would have reduced through those deductions. And go ahead and reduce your disqualified basis to the extent you have dividends paid out of the extraordinary disposition account that become taxable dividends because of the ED rules.
Yeah, it certainly makes sense from a policy perspective why they chose to address it this way. And you're right, they had a couple of different ways. But the one thing that I'm left with, and I think this is really a common theme with a lot of these regulatory packages that we've received on the TCJA, is like, holy cow, this is going to be really complicated to comply and keep track of all of these different accounts and the adjustments that need to be made. But, that's, I think, just part of the new system. And I think, understandably so, trying to protect the government's interests where we started this from. So, Aaron, thank you very much. A really interesting discussion on a very complex topic.
Hey, thanks, Doug. Really appreciate the time to talk.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. A special thanks to my guest, Aaron Junge, an international tax partner in PwC's Washington National Tax Service. I'm Doug McHoney, PwC's U.S. International Tax Services leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.